So thank you everyone for coming. My name is Alex Wilson. I'm broker owner of Remax Wealth Builders Real Estate. And one of the most common questions I get is, Alex, how do you get mortgages for your real estate portfolio? And I thought, what better way to answer that than the person that gives me the mortgages for my real estate portfolio, and that's Amit Puri. So Amit, why don't you give some details about yourself?
Alex, first of all, absolute pleasure to be here. It's been a long time. A lot has happened since we've had our last video. We both had a chance to work on our golf swing as well, so it's been good. Quick 25-30 second background on myself for those that are joining in or haven't been on any of the other videos in the past. Julick Business School 20 years ago, worked at KPMG, found my way at Deloitte, chartered accountant background. 14 years ago, opened my own mortgage business, and here we are. Rest is history. My team is the top, thanks to Alex and all of his friends, is the number 1 or 2 brokerage and team in the entire country for 7 years running. So thank you to him, first of all, and all the support he gives us. And that's what we're here to do. So again, yes, the Q&A is the most fun, and I can see questions already started there. So happy to jump in and answer whatever questions we have for the group. So mortgage broker, accountant, 14 years, pretty much seen everything, and we're here to help.
And I got to say, this has got to be one of the most interesting times for me personally, getting mortgages now. And we'll dive more deeply into that, but there's definitely some interesting things happening out there. So I want to get everyone in the investment mindset. So I'm just going to share my screen quickly. Again, those that have seen my presentations before will recognize this, but I'm only doing 3 slides, not 40. So so my name is Alex Wilson, owner and broker at Remax Wealth Builders Real Estate, which I mentioned before. Been selling real estate in Toronto. That's 15 years, not 12 years. Got to check that, fix that number. Number 1 Remax agent in Canada for individual transactions in 2022. Number 11 Remax agent in the world as an individual in 2022. So last year, been inducted in the Remax Hall of Fame. Awarded the Remax Lifetime Achievement Award at 35, and I've been awarded the Remax Circle of Legends award, but none of that is relevant to anyone on here. What I care about and what I want to show you is how I've turned a $39,300 deposit into a $17 million real estate portfolio, which includes 15 condos, a High Park triplex, and an apartment building in Hamilton. Oops, lost that. So here's my whole portfolio here, and the person that literally gets me the mortgages for these properties is Amit on this screen. And why I love this slide is one of my favorite slides, and why I start all my presentations with it, is that a lot of people look at real estate. I shouldn't say a lot of people, but people sometimes look at real estate as a way to get rich quick. And that is a great way to lose a lot of money. But if you invest in real estate and hold it over the long term, you can build tremendous wealth. So the current market value of my portfolio is over $17 million. Of course, I have mortgages on all those properties. There isn't $17 million sitting in my bank account. Those properties are mortgaged, but the power of that's where the power of leverage comes in. Over 30 years, and why I look at 30 years is 30 years is the time period you're going to amortize the mortgage on the property, pay that mortgage down. There are going to be tenants in that property paying that mortgage down for you. And if I just take a conservative 3% compounded annual growth rate, my portfolio will be worth $42 million in 30 years. And at that time, I'll be 70. So I will have a fully paid off real estate portfolio at 70 years old worth $42 million, which if I applied a 5% annual rate of return on that, I could pay myself an annual salary of a very significant amount, over $2 million a year, if I wanted to, because I have that fully paid off portfolio that other people have paid off, the tenants in the properties, and it's an exchange. I provide a roof over their head. They need somewhere to sleep. and they provide me with money that covers my mortgage and my property tax and other expenses on the property. And so when you do that over, when you apply that terminology over the long term and you multiply it by having a number of properties, that's when you build significant wealth. Now that number may dump people like Alex. I don't know if I can do, like, that's a lot of properties, that's a lot of mortgages, that scares me. But you don't need to do that much. You could just have $1 million real estate portfolio or a $2 million real estate portfolio. And $1 million may seem like a lot, but heck, that's not, that's 2 studio condos in downtown Toronto is more than $1 million. But where that again comes into play, if that value, that $1 million be worth 2.4 million in 30 years. And I do inflation adjusted numbers. So if I apply the adjusted inflation, 1.4 million, I could pay myself a $70,000 rate of return on that $1.4 million portfolio. And that $70,000 is in today's purchasing power. When I have recommended payout, that's paying at a 3% versus 5% if I want to maintain 2%. And that's how I build generational wealth, because then the inflation is not eroding on the value of the portfolio, but my team always starts giving me crap for when I get into more details like that and say, Alex, just keep it simple, don't get into that. But it's important to know. So 1 million, if you have a $1 million real estate portfolio today, you can build yourself basically a pension plan that you could pay yourself $70,000 a year in 30 years. And that's in today's purchasing power, 2 million, 140,000, 3 million, 210,000. But the key thing is, and I'm done with my slides now. The key thing is the mortgage is actually what allows you to do all of this. And you need a lender to work with. I shouldn't say a lender, you need a professional to work with that knows how to work with investors to build that portfolio with you, to know which mortgages you need to get for the portfolio. And that's where I've been working with Amit for probably about 10 years now doing this. And he's the one that's helped me build this portfolio, a key person in the background. So Amit, I'm going to start it off easy. A lot of people, when they think of I'm getting a mortgage and they go to the bank and they go to get a mortgage, I can tell you right now, if I went there to my local branch down the road to get mortgages, that they wouldn't give me mortgages for my portfolio. Would you agree with that?
Absolutely, 100%.
They don't know how to do that portfolio. But I do have mortgages from those banks down the street. Currently all my mortgages are banks that are down the street right now. It's just that when you go to a branch, the person there is really a jack of all trades, a master of none. They're used to giving a mortgage for someone that's buying a house. And that's really their skill set. When you get into a multi-layered real estate portfolio, they don't know how to do that. They don't know how to put the right numbers in and then present it to the underwriter. Because ultimately, the underwriter is the person that Amit works with at various financial institutions to get these mortgages through, so that the I's are dotted and the T's are crossed, so that the bank is happy. But there's a certain way to dot the I's and a certain way to dot the T's, and only a certain individuals know how to do that. But banks aren't just the only lenders you work with. So Amit, why don't you talk about the different lenders you work with and the different levels that they are?
Absolutely. I think we've used this phrase before. Everybody gets a mortgage. It just depends which bank and which rate. And I've been answering questions as they've been coming up in the chat, so we can attack those later as well. Yeah. There are multiple levels of lenders in Canada. Everybody knows level A. We'll just go ABC just to keep it simple. RBC, TD, Scotia, National, CIBC, the big banks. They have a way to do business where you have to fit into their parameters. If you don't, sorry, you don't get a mortgage. Generally, they like as you mentioned, people who are buying their first home. Easy peasy, no complication, and off they go. The minute you get into investing, some of those lenders are capable, some are not, which we have learned over the years. So to just keep down that trajectory, after the AAA banks comes trust companies, also known as B lenders. They get a bad reputation because they do everything. They do people who, like us, properties in the double digits, They also do people who've gone bankrupt and don't have credit and shouldn't even be buying a home, but they are allowing it based on the property at minimum or the character of the client. So those are the trust companies. Once you exhaust that, there is C-level, which is credit unions. People have heard of them. There's Italian credit union, auto workers credit union. The list goes on and on. To give the listeners perspective, we have over 39 banks that we work with. I am pretty sure I can't even name all those 39 banks. Most people can only name maybe 10. So there are 39 Canadian banks that do mortgages. The final layer, which gets the worst rap, is private lending or mortgage investment corporations. They will give anybody a mortgage. The only downside there, their interest rates are a little bit higher. But if you're entering, we had a client, I think, but last year, 30 properties, like 29th purchase. At their level, they don't care what the rate is. They're building a portfolio of assets. They're writing that interest off against all the profit anyway. So to answer your question, in my opinion, there's 4 levels of lending. Banks are A, trust companies B, credit unions are C, and then at the end you have private mortgage investment companies.
Yeah, and they all have need. Now, I've even done private lending before. Like I've signed a private. I wasn't doing the private lending. I was getting the private lending. An area where it's very common is when you're doing renovations on houses. You need the private lending and the funding on that. So that's where I did private lending on my side. And that's
Absolutely.
yeah. When people hear the BRRRR method using other people's money, that's private lending.
OPM, other people's money. Yeah. That's the process.
And what that apartment building you see in Hamilton, that was done with private money. I did that in my early 30s with business partners, and we were able to do that with private money. We couldn't do that with the bank. There was no bank.
So to explain private money is you could borrow money from your friend, your relative, your cousin, your neighbor, your coworker, set an interest rate, and you just meet the obligation. That is called a private loan. Now, one reason that private is so important in the country, no bank or trust will lend on a property that's less than 97% complete. And that means a house that maybe is missing the landscaping or the grass, that's about all that can be missing. If you're missing a kitchen, light switches, baseboards, you're not getting a mortgage from any of the banks. And people don't realize that, especially when they're going through a build process or any sort of construction phase. So private lending is a great niche that fills a much needed requirement.
At 100% agree. Now, when people look at my portfolio, they're like, well, how do you get mortgages? And the first thing I say, you got to deal with someone that is used to dealing with investors, which I think we covered, where I said, like, if you just go to your bank, I can't get mortgages just from going down to my bank down the road. It's just not going to work. So
let me jump in and explain that so that people understand that the difference there. When you go to a branch, the individual you're dealing with, they're all fantastic people. Friends of mine are advisors at branches. It's where a lot of our business can come from. They are selling credit cards, student loans, medical loans, car loans, RRSPs, safety deposit boxes, and then they end up doing mortgages as a side piece. They generally don't have the know-how or the skill set to explain the investor to the risk team or the underwriting team. So when you do a mortgage, being in the industry long enough, we have dedicated individuals at the bank who are used to our files. We don't have to reinvent the wheel. We give them a client with 12 doors, 16 doors, 20 doors. They already know what we're going to come to them with. The understanding is already built in, and the underwriting team works with us. So when you go to a branch, there is just not enough experience there for them to be able to explain the file in layman terms to the risk team and then get it approved. I mean, that is the difference, I think.
Oh, 100%. And you made me think of something as well. When we were talking about the big banks, which people know, but what people don't realize is that every year banks change. And what I mean banks change lending requirements. Banks change their appetite for lending in certain areas. So let's say this year CIBC really likes Toronto downtown condos. then they're going to make a push for Toronto downtown condos. But let's say they're like, we have a lot of exposure in Toronto downtown condos. We're gonna pull back on the lending on the Toronto downtown condos. The key thing is when you work with a mortgage professional that works with many different banks, they're aware at that time what banks are giving or have an appetite for your investment portfolio. So it's important to know that, because especially when you grow in the number of doors, there are certain banks that will say, hey, I'll give you 5 mortgages for 5 investment properties. That's it. Doesn't matter if it's with us or with another bank. Another bank could be like, hey, I'll give you 10 mortgages, and I'll give you 10 mortgages in my bank. And I don't care if you got mortgages in another bank, but I'm going to give you 10
Correct.
in my bank. But then that could change the following year. It just depends on what their appetite is.
So that's what I call the aggregate effect versus the per door effect.
Mhm.
So what ends up happening, to piggyback on what you said, is let's say your mortgage limit is $1 million, just for argument's sake. A bank like TD, they will give you $1 million total across 3 doors or 2 houses or 5 houses. A bank like Scotia or National or CIBC, they'll do $1 million per door. So you could have 5 $1 million mortgages, but you cannot have 1 $5 million mortgage. So it literally is, when you go to a broker, again, it doesn't have to be me, as long as it's someone capable. When you go to a broker, it's the equivalent of you knocking on every bank's door with your application, and an experienced broker will be able to send the application to the lender where it should get approved. It's not throwing darts at a wall, sending it to 15 different banks and hoping someone agrees. No, it's knowing the policy, knowing the product, knowing the location that some banks like to lend in versus others, and then give it its best opportunity.
Yeah, 100%. And that's also where, because a lot of people, this is the perfect segue that you gave. A lot of people look at the value of my portfolio and like, well, how can you get the mortgages for that amount? And lenders look at investment properties different than your own personal residence. Remember, your personal residence, that is your house that you live in. That's debt. That's there's no income attached to that property. With investment property, there's rent. And the bank will look at that rent when they look at investment property. And that's where it's important when you're buying investment real estate, where there is cash flow is important, because the bank will include that in a portion of that into the income equation when they're looking at giving you a mortgage on that property.
Correct. So there are some banks that will, let's say you're getting $2,500 of rent in your condo. Some banks will only use half, which is $1,250, but your mortgage is $2,000. All of a sudden, your property is a loss for the bank. So that hurts your mortgage ability. Some banks use 100%. So all of a sudden, it's like the property doesn't exist on the application. We call it a wash. So yes, there are certain lenders that are more aggressive helping investors, and there are some banks that, good luck, you try your heart out, it's not going to happen.
Yeah, and again, that's how banks won't say, hey, I'm not doing that lending anymore. They're just gonna tighten their underwriting criteria.
Correct.
And that's naturally how they will lend less. They're just like, well, if you
Correct.
don't fit this, I'm going to make my box smaller. And if you don't fit in my smaller box, then I'm not lending to you. But if they're like, I need more mortgages, I'm going to expand the size of my box and my underwriting criteria.
That's correct.
And that's where I go to my next point here is, when you're working with your mortgage professional, and especially one that is experienced and knows what you're doing, have patience. Again, I've been getting mortgages for 10 years. You need to have patience with your mortgage broker. They're going to ask you for documents, and then they're going to ask you for more documents, and they're going to ask you for more documents, and then they come back and they're going to ask you for more documents. It's actually not them that's asking you for the documents. Someone else is asking them for the documents, and that's that risk professional, that's that underwriter, that's at the bank that's asking for those documents. So when your mortgage professional asks you for those documents, don't get upset. Just go, thank you for working so diligently on my file.
It's actually a good sign, because if documents are being requested, that means the bank is continuing to work on the file, and the probability of the approval is increasing. Because when a bank doesn't want to do the deal, they just decline it and there's no documents to request. So I always tell clients, if you haven't heard from your broker in weeks and your closing's coming up, that's probably a bad sign, because they either haven't done their part, or the bank had turned it down a while ago and you don't know.
Mhm.
So asking for documents is a good thing.
Yeah, and I only bring that because I do know people get frustrated, but it's, again, you guys saw my numbers. I I hang out with many other large real estate investors. It's common. It's the reality of doing that, and it's fine, right? Like the bank is giving you money, right? So they just want to dot their I's and cross their T's. They want to make sure there's no fraud going on, that kind of stuff. So they're just going to ask you for a lot of documents.
Alex, for
Okay.
one of our clients that had 29 properties,
Mhm.
my documentation was 900 pages.
Oh, I believe it.
Right? 29 properties, that's 29 mortgage statements, 29 tax bills, 29 3-month bank confirmations. It's already 250 pages right there. So
The leases,
the leases,
yeah,
the income,
the confirming the property tax bills, just every like
their
single
tax
document.
return alone was 70, 80 pages each, and you need it for 2 years plus their spouse.
Yeah.
So documents is a good thing, everyone. If you're being asked documents, that means your file is headed in the right direction.
And for those aspiring investors, or for those investors that maybe don't need a mortgage right now, it's not a bad thing to start getting your documents in order, because when you go to get that mortgage, they're going to be asking for all those documents. And another thing, they're going to ask you for wet signatures as well. So what a wet signature is that I use DocuSign for my real estate selling business, but the banks don't always like DocuSign. So Amit may, hey, I need you to fill out this form for TD. And then you fill it all nice out in Adobe and you sign it and you think it's good and you send it back. I'm like, no, it needs to be wet signature. You're like, wet signature, what's a wet signature? I don't got a printer, and you're running around, that kind of stuff. Just again, these little things that when you're in the deep of it and getting the mortgage, things that you should know. Just be prepared to do wet signatures. And what a wet signature is, that's actually you taking a pen, signing the document, and then scanning it over. That's what I'm referring to on a wet signature for those. That's what they require. So just patience goes a long way for getting the portfolio. It all works in the end. Short-term pain for that long-term gain for the value. Now, something else I want to address.
Banks and lawyers, and I think one of those few silver linings for COVID, even saying that sounds like an oxymoron, but one of the silver linings of COVID is everyone's gone digital, including law offices, branches. I had the HSBC Bank the other day. They had to do a interview with the client. Time was running out. We said, can we do Zoom? They said, sure, done. So something that should have taken 2 hours out of someone's day, it was a 7-minute process over Zoom, and that's surprising.
Yeah, no, for sure. Now, what I wanted to tap you for, do you think it's going to get easier or harder over the next 6 to 12 months to get a mortgage? I know what the answer is, but
the answer is it's already tough as nails, and I think we're stuck in a holding pattern. That is a loaded question, which I could take in a lot of different directions, but to keep it simple and try and answer some of the questions I've seen in the chat, it's we'll have to address those later. I can't keep up with all of them, but if we rewind the clock to 2016, you used to get 10, 11 times your income as a mortgage. So if the average person makes 100 grand, they get $1 million mortgage. Then in 2017, they introduced a stress test. It became 7 times, 8 times. Up until February of last year, so February 2022, people were still getting 7, 8 times their mortgage. And the market was on fire. Everybody was, singing Kumbaya. Rates have gone up, and that also caused the qualification levels to get tougher, hence drop. So now people are averaging between 4 and 5 times their income. So until the rates come down or there's some sort of government intervention, something I learned reading Ray Dalio's book Principles, you can't account for government intervention. So unless the government steps in, changes the amortization period, or changes the stress test, I think we are stuck with a crappy limit for the general population in terms of mortgages. Now, that being said, many banks have introduced supplemental programs such as net worth, self-employed, rental offset, etc., etc. So the answer to your question is no, it's hard. I have had more doors shut in my face in 6 months than I've had in 14 years combined. It is a test for everyone. It is tough, but we will persevere, and the rates will come down. I mean, that's a whole other segment to talk about, but rates will eventually come down. I think we have about, we were talking about it, what, a couple weeks ago. I think
Yep.
6 to 9 months, maybe 12. I think things should be back into a manageable standpoint.
And again, I bring that up so that just people don't get frustrated. The good thing, if it's harder to get a mortgage right now, it means there's opportunity, and there's opportunity in the market. And if you're able to get into something now, then when things loosen up again, you'll see prices jump. And
So people that are taking advantage, just sorry to jump in,
yeah,
people
go,
that
no,
are
of
taking
course.
advantage of these opportunities is a great comment, because we talked about that A, B, C, D lending.
Mhm.
You know, I used to do 90% of my business with the banks. Now it's 50 because 40 has shifted to the trust companies, and that trusts are running out. So it's shifting to the credit union. So I think going back to, is it tougher? Yes. But if clients and customers change their perspective on, you know what, I have to get a Scotia mortgage. No, you may not get that. You might have to go with a different lender, but you'll get it. So I've seen a shift in the market where A has gone B, B has gone C, and C has gone D. So people looking for opportunities are able to find them and continue investing.
Yeah, and that's why I love starting with that first slide where I showed the portfolio over 30 years. Don't think of it in short-term increments and what the pain is now. Look at that gain and what you're trying to do in that 30 years or 20 years or 10-year marks, because that's really where the gain is. Because things aren't going to stay like this and things are going to change. You know, could it be 9 months? Could it be 12 months? Could it be 18 months? But things 100% change. When rates started rapidly increasing, I went back to the early 80s, and at the peak rate in the early 80s, I'm gonna tell people two things. The peak rate in the early 80s was in August 1981, and it hit 20. Was it 21.6? Or no, I think it was 20.67%. Now people may be freaking out, like Alex is saying, over a 20% interest rate, but rates where they're at today actually have a larger impact than a 20% interest rate in the early 80s because of the amount of leverage that people have. So we're at 4.75 now, right? Amit?
For the fixed rates,
No, 4.75 for the bank rate.
6.95, my love.
Oh no, yeah, well, no, that yeah, for the prime,
Yes.
the prime, yeah, 6.95. But the Bank of Canada rate is 4.75.
Correct.
Yeah. So 4.75 has a bigger impact than 20.67 in the early 80s because of the amount of leverage that people have. There isn't much more room to, if they go up a little more, there isn't much more room left. The pain is already happening. So then going back to the 80s. Okay, so the 80s, I hit 20.67 August 2081. By January 83, I was down to into the mid nines for 9 point something and change for the percentage. So it dropped over half of what it was. Not saying it's going to drop a half of what it is now, but you're going to see that rate come down. When they start going down, it starts going down quickly. So we know that will happen. Will it happen in 12 months? Will it happen in 18 months? When will that start? We don't know. But it is going to happen. That's why you can take advantage now. Will you pay more interest now? You will. But that's where if you work with a experienced mortgage professional that deals with investment properties, they will be able to find you a mortgage product to get you into that property. And you may then refinance that property in a year, 18 months, or 2 years, or 3 years. And then you'll jump from that D to a C, or a C to a B, or to a B to an A. And that's how you play the game.
Yeah, for those that may not qualify at the RBCs and CIBCs and BMOs, if you get a mortgage at a trust company and 18 months goes by and now the rates have come down, which is what the expectation is, all of a sudden you will qualify at the banks once again, because just that concept, 4 times income versus 8, it is a massive delta for what is going on. So
yeah, you will qualify. So what I'm going to do now is let's start looking at the Q&A questions, because the great thing is with these Q&A questions, a lot of great questions will come and we will be able to answer.
so I've answered some of them, and many are still pending. So
okay,
feel free to start where you want.
My marketing managers just asked 3. So let's hit those up right off the bat. When do you generally need to have a mortgage in place by?
You need to have a mortgage in place. I think it depends. If you're buying an investment condo or a new construction, that something like that is sometimes required before the cooling off period. Correct me if I'm wrong.
Well, yeah, just that'd be a mortgage pre-approval, that kind of thing. But the actual mortgage
The actual mortgage, it is advisable that you. So if we work backwards, your lawyer needs the documents 5 to 10 days before closing, and the bank needs about 5 to 10 days. So I think 20 days before closing, your mortgage should be done.
I like this next question. How much will a mortgage underwriter focus on the property fundamentals cash flow profile versus your personal credit profile? So I'm going to take this a little farther. Because we haven't even touched into this. We were talking this like we were talking about residential mortgages. We didn't talk about commercial mortgages yet. If you were to get into commercial property, multi-residential commercial property, so what would you like? I know 6 doors, let's say 8 doors to be safe, because 6 doors is kind of a fringe area, right? Is start at 7?
Once you hit 5 or more doors, it's considered commercial.
Okay.
It stops falling under residential. So 4 or less is residential.
So I'm just going to say 6, because it does get into a gray area, because sometimes when you're in 5, the commercial guys are like, I don't want it. And then the residential guys are like, this is too big. So we'll say you're at 6 doors in a multi-residential property. Your actual personal profile means very little. It's the actual profile of the building at that time. That's what they care about.
That's correct.
So an underwriter will focus, if you're getting into the multi-res, on the property and the fundamentals of the property and the cash flow of the property versus your personal credit profile when you get into multi-res. But when you're into just strictly residential properties, they're looking at your
Personal credit
profile. But this is all. But when you look at residential and investment properties, they will, depending on the financial institution, they will look at the rent that property is bringing in.
Let's call it the 80-20 rule.
Yeah.
So when you're doing commercial or multi-residential, 80% is the property, 20 is who you are. And then in residential, other way around. 80 is who you are and 20 is the cash flow.
And then the next thing, will they use investment cost base or current market value to determine loan to value?
The answer is they will take the lower of the appraisal or the purchase price. Yeah. Neither of those actually matters.
Perfect.
So technically it's the current market value. So if you buy something for 2 mil and the appraisal comes at 2.2, they'll use 2 mil. If it comes at 1.8, they'll use 1.8. So it's the lower of.
Great, easy question, but a great question. Would credit score for clients will your credit score be affected if you submit to multiple lenders? That's actually a great question, because it will, right?
Not.
Oh, sorry. You answered that better, because I answered it incorrectly. So you answer it. If it's more so.
If you pull your credit, so I get this question literally every other file. Mm-hmm. If you pull your credit 10 times in 2 days, your score will not change. It does get affected by your balances. If your credit card has a balance of $100 and then you buy a coffee at Starbucks and now it's 105, the score drops. So the score is based on how much you use your credit. What ends up happening though, if you've pulled your credit 10 times in 2 days, the bank, the 11th bank looking at the file, their red flags are up. They don't want to touch your file. They assume something's wrong. So if I get a client and I pull their bureau and they've been to mortgage broker A, B, C, D, E, F, G, TD, Scotia, automatically I know the deal's not going to work or something's wrong because nobody does that. So it's a qualitative issue versus a quantitative issue.
Great answer. Great question. Simple question, but great question. Because when you I don't want to go to 10, 20 different mortgage brokers. Like, you want to work with one dedicated that's going to get the deal done for you. Because you got to look at the big picture, especially if you're building a whole portfolio. I'm not looking at one mortgage. I'm looking at that mortgage and the next 5 mortgages, and how I'm going to structure everything for that. And I want to work with a professional that can help me do that. And I can say, like, I have closing this year 5 properties. So for me, it's very important for me to work with a mortgage professional to knows how to structure me in that way. So you need to work with someone that knows how to stick handle you when you're in those situations. Another good question coming up: when you are getting a mortgage for a pre-construction condo, is it at in-term occupancy? No. In-term occupancy is when you get keys for the property. And at in-term occupancy, you'll be paying an occupancy fee to the builder. The building hasn't closed yet, so you wouldn't be getting a mortgage at that time. Now, you could still, I do think it's prudent at that time to then start working on your mortgage. So at in-term occupancy, you can go to Amit going, hey, I got in-term occupancy on this. We can get a mortgage. What percentage would you say? 80% in place, 90% in place?
80%, correct.
80% in place, and then they can do a lock on the rate for, typically it's 4 months, right?
It depends on the program at the bank. So long story short, you can hold the approval indefinitely as long as the client's circumstances don't change. If they're working at the same job and credit's generally stable, the bank every 3 months will auto reapprove the deal. So we've had files that are approved for years on the system, and we're just waiting for the day of the closing.
Oh, I'll just clarify my question. It was you lock the approval, but the rate is locked for 120 days, right? Or 90.
Correct.
120?
The rate can
90,
keep changing. Correct.
Yeah. Lastly, is the lender going to do another credit check before the official closing if you were already approved?
It depends on the lender.
Yep.
Not all of them do it. Some do. When, again, this comes down to client understanding. When we know there could be something that may change in the future for the client, we'll try and select a lender where we know they don't check again.
Yep.
So it depends. And we're talking about TD versus HSBC or National Bank. We're not talking like a Mickey Mouse bank. Like, they're just some of the big guys, they approve it once, they're done. Some of them will check every 90 days, no matter how long you're with them.
Yeah. So, and these are important things. I'll give someone an example. Let's throw an example out there. Let's say someone's going on mat leave, right? Let's say a mat leave comes up. That can impact how much you're going to qualify for. Because I just had a client go through this. She was pissed. But that's good. That's going to impact how the bank views you. But
Correct.
That process started after she was on mat leave, and the property was purchased after she was on mat leave. If you did something before your mat leave, and then you were approved and everything in place, and then mat leave happened, depending with the financial institution, you may be okay, correct? Given
You may need to redo the file. You may not have to. It goes back to the bank. Yeah,
exactly.
Some banks, like just off the top of my head, Scotia, for instance, if the maternity leave is longer than 12 months, they automatically use 60% of the income. So, and if it's under 12 months where you're returning, they'll just use what you left at. So
Perfect.
if you're 100K income, they use 100. But if you're coming back in 13 months, they'll use 60K. That can kill a file. I believe TD, for example, doesn't have that distinction. They use 100% all the time. So again, the lender depends on how you approach the file.
Yep. How quickly can you refinance a mortgage? Oh, good question. How quickly can you refinance a mortgage? I've done this. I'll stop jumping into my own on the question though, but how quickly can you refinance a mortgage on a pre-construction once it closes?
Next day.
Yeah.
Depends on the lender. So now if we know that your goal is to refi because you bought the condo at $500,000 10 years ago and it's worth $1 million, we will go to a lender where the refinance is allowed the following day, literally the day after you take possession. Some lenders, you have to wait up to 12 months. So again, distinction with lenders.
Yeah. And that, again, that's having the conversation with your mortgage professional going, hey, here's what I plan to do. And then they know how to structure you in the right way.
Correct.
This is a good question. Because I have my standard response, and maybe you'll change differently. Maybe you'll say something differently. If I purchase a pre-con at 10% down, can I qualify for a mortgage? Or do I have to add another 10% at closing to qualify for mortgage with 20% down paid?
So there's two minimum requirements. In order to put less than 20% down, the property has to be $999,999 or less. So it has to be $1 less than $1 million, and you have to qualify. So when you qualify with less than 20%, you've now added two barriers that you have to cross. First, the bank, and then the government channel. That's called CMHC or Canada Guarantee. Their policies are different. So not only do you need bank approval, you need government approval. That 4x becomes 3.9x, or it's slightly tougher, but the answer is yes, you can qualify with 10% down.
Now, what if it was an investment property?
If it's an investment property, you have to do 20%.
There we go.
And if you're buying your second property, you're disqualified from the CMHC insured programs, unless there are circumstances where, let's say you're living in Vancouver or Calgary, because that's where you do a lot, and you're moving to Toronto. So if you can prove that you're moving to a new city, then they will sometimes allow a second property under 20%. But those are, every blue moon. It's not common by any means.
Perfect. Can a bank increase a mortgage period? Keeping in view the present increase. Okay. Can a bank increase the amortization period, keeping in view the present increasing interest rates beyond affordability?
I think what this question is asking from Dinesh is, with the stress test and people being underwater on their mortgages, amortizations have skyrocketed because some banks have static payments and some don't. So for those listening and those people that have mortgages that the trigger rate has not been issued, which essentially, if your mortgage payment is less than the total interest you owe per month, you're not chipping away at the amortization. And so some banks have pushed it internally to 40 years, some have gone to 60 years. I've heard murmurs that some banks are in the hundreds in terms of their amortization, and they are also waiting for rates to come back down so they don't have to affect, the 15 million mortgages that are out in Canada. It's lender specific.
Which banks have the most friendly net worth based program on a dollar per dollar basis? Say 1 million liquid investable assets would let you borrow up to $1 million mortgage. I've worked with BMO before. Any other banks?
Scotia, HSBC, TD, CIBC, and every trust company. So depending on your caliber as a broker, banks will offer certain niche programs to certain brokers. So the net worth program is offered not all brokers are created equal. I don't know how to explain that. Like the net worth program, I have it at 4 or 5 banks. A newbie who's just become a broker may have none because he hasn't earned the reputation of that lender to have that program. So to answer this question, TD, HSBC, Scotia, CIBC, and every trust company for me.
What is the risk as a client to go with a B or C lender aside from paying a higher interest rate?
Financially, none. It comes down to optics. If you don't pay your mortgage at BMO, After 3 months, they don't kick you out. After 12 months, they don't kick you out. They don't need the headlines that BMO kicks out family of 4 in the middle of winter. The B and C lenders, they don't care. You don't pay your mortgage, they start the power of sale proceedings, and within 3 to 6 months, a sheriff has taken over the property. So that is the risk. So as long as you make your mortgage payments, there's no risk.
How long would you need to build equity in a house before you can use it towards another property? I think there's no time limit.
There's no time limit
Just
because
if there's
it
equity in
goes
the house.
back to that question. You can refinance the next day after a condo closes. So as long as there's enough equity to pull out, like the cost to refinance is, call it 1,500 or 2 grand. As long as you're pulling out 10, 15, 30K, it kind of makes sense. You're not going to go through the process for $5,000 and spend 2,500 in legals.
Yep.
So the answer is, doesn't matter. You can go after $1 if you want.
Good next question. I'm in progress Scotia to begin a step mortgage to get going on investment properties. Do you know this product? Is it good for this purpose? I'm going to jump in before you answer.
Go for it.
That's how I built my portfolio. I shouldn't say not my whole portfolio, but a good chunk of my portfolio was built with the Scotia step mortgage program that I got in 2016. And I will let you answer more.
Perfect. So STEP, for everyone listening, it's Scotia's term for Scotia Total Equity Product. Every bank has some version of this. TD's is a flex line. Manulife is called all-in-one. RBC calls it the home line. Every bank has some sort of equity product that as you pay down your mortgage, you can tap into what you've paid. This type of product is generally reserved for, top caliber credit, top income. It's just not given to everyone, but yes, if you are able to get an equity product, you always take.
Yeah. What I tell people, it's all about access to liquidity. You want to have liquidity. You want to have credit. You want to have the access to cash, right? You don't need to have physical cash on hand, but you need to have access to cash. So if you're able to get extra credit, take the extra credit, because when you actually need the extra credit, you're probably not going to be able to get it. So there's probably a reason you need the extra credit. So it's better to have the credit in place beforehand when you can get it, so that you're not in a situation when you need it and you can't get it. Always take liquidity. Where am I here? Okay. I like this question too. And it's a good question for you to answer, because I haven't done one of these in a while. If you buy an assignment with, let's say, 200K above the original purchase price before closing with the builder from someone, when you try to close on it, how will the bank appraise and lend? Is it based on the market price or the original purchase price? And I'll clarify that. Is it based on the assignment price or the original purchase price? That's a better question.
Yeah, so let's throw an easy numbers at it, right? You buy a condo for 500 and then you sell it to someone before closing for 700.
Mm-hmm.
So the question is, will they lend on 5 or 7, correct?
Mm-hmm. Yeah, that's perfect.
It depends on the bank.
Correct.
A lot of banks will do it on the original only, no exceptions. A lot of the banks will do it on the assigned price. Now, the assigned price, some banks demand builder consent. Some banks don't care. So you just do it on the assignment, the ORIA document, the assignment to sell one. So the answer is, it depends on the bank.
Yeah, and again, work with a trusted mortgage professional. Again, if assignments are a pain in the ass, they're complicated. So
you can always get lending on the assigned value. I think that's the answer people want to hear. So yes, you can buy it on the assigned value, but when it's an assignment, the appraisal has also become almost mandatory, because you can't just assign something for some ludicrous price and the property's not worth that much. So there's other checks in place.
Correct. Yes, 100%. What is the process to changing commercial mortgages from private or C lender to be a lender? Do you want to handle that one, or do you want me to talk about that a little more?
We can do it together, but if it's a commercial mortgage, it's a commercial mortgage. It can't be switched to residential. So just to clarify that. To switch from private or C to B and A, it literally just depends on, do you qualify at the better lender? So
Yeah,
it doesn't
usually
make a difference.
if it's a commercial mortgage, then it's the actual property that they're looking at, like
Right.
an 80/20
It's either
rule.
zoned commercial or it's the number of units.
Yeah, so typically in that state, if I'm in a private mortgage, let's say on a multi-res property, it's easy example, on a multi-res property, it was probably in bad condition before. And what I'm doing is I'm fixing up the property, I'm getting the rents up on the property, so that I make it look much better on paper. And at that time, then I can go refinance with a lender, B lender at that time. So that's typically what you do. So if you have a private in place on a multi-res, it's probably not in great condition, and you're fixing it up, you're getting it fully 100% rented, you're getting much higher rents on the property, and then you refinance that out at the A lender, and then you pay off all the private lenders on the property. Where was I on there? Okay. Would it be easier to close on a cash flow? Would it be easier to close on a cash flowing property in Calgary using a corp or personal? Ooh, the good one.
This is our favorite question now. Holdco
How
versus
many
personal.
questions did we answer before we get to Holdco? I was actually like, wow, we have not had a Holdco question yet.
You want to take it first, or you want
No,
me to take it?
no, I want you to, like, I have different views on Holdcos than even you do. Actually, I'm going to take this first. I'm going to answer it. And
I knew. So go for it.
so, Holdcos for me, and the only true value for a Holdco is if you own an incorporated business, and you have money in, and you leave money in that incorporated business every year, then Holdco offers value for you, because what I can do then is I can buy real estate in a separate company, not my operating company, not the company I make money in, but a separate company called my holding company. And I use the excess funds in my operating company on a yearly basis to invest in real estate. Why I do that? There's a tax savings. So instead of paying 56% on the personal level, I can pay 12.5% on the small business side, or if you exceed 500,000, it's 25%, but it's still less. So that's the real reason that you'd be investing with a holding company. If you're just a T4 individual, just buying your personal name. That makes the most sense. Now I'll let Amit elaborate more.
So this is where I have two minds of it, because as a mortgage broker, I have different answers. As an accountant, I have a different answer. So I agree with everything you said. If you have your own professional corporation, medical, real estate, legal, accountant, it does make sense to have a holdco. But anything else, it doesn't generally have to go into a holding company. Now, to answer this question, would it be easier to close in a corp or personal? The answer is personal. 80% of the time. Banks are a lot more difficult with holding company mortgage applications. That doesn't mean they're not going to do it. If you have 10 lenders you can go to, you've automatically knocked it down to 6. And the 6 that are going to look at it, if you're using a corporation, they assume you have others. So they're checking on you even more thoroughly than they would if it's just personal. So the answer is, it's a lot harder to get a mortgage in a holding company, but it doesn't mean that it's difficult. It really depends on each individual circumstance.
And there'll be more documents. And
That's an understatement. That is an understatement.
I will attest to that. And there's more tax returns for you to complete too. You know, there's a cost for setting up the holding company, and there's a cost every year to maintain the holding company. So not only are you doing personal taxes, you're doing taxes for the holding company.
Correct.
And again, the easiest disqualifier for this, if you're just a T4 individual, you don't need to do this. So just forget about holding companies. You don't need to do it. It's just for incorporated companies, for those people with prex, people with personal, those various corporations. So
the short answer is, it's the easiest way to move money out of one company into another for people that own companies. So holding companies make sense. For people that are not in corporations, it makes no sense.
Okay. This is a good question. If you have no down payment yet, but have equity, will the bank allow you to take equity out, refinance in order to get the 20%? Yes.
The answer is yes.
Yes. That's so I will go back to this where we're talking about the Scotia Step program. That's exactly how I did it personally with the Scotia Step mortgage. And again, every bank has something similar to that. The Scotia Step one is just the one that rolls off my tongue because that's what I use. So yes, that's how you can use your. I have the line. I didn't include the slide, but use your home to fund your retirement. Keep your home in retirement. Use it to fund it now. So we all have these. If you own a house, you've had a house for 5 to 10 years or longer. It's gone up in value. Now you could sell that house to unlock that equity, but then you still got to go live somewhere else. So unless you're moving to a lower cost area, there's nothing good for you there.
Exactly.
So how do I tap into that equity? How do I make a return on that and the increase of value of your home? You would use the equity in that existing property. Also, there's in my other webinar that I did talking about growing a portfolio, turning one condo into 3 condos. Let's say you bought one investment property, a condo 10 years ago. Awesome work. But the mortgage on that is probably like $150,000, but the value of that condo could be $700,000, right? So now we're sitting on a significant amount of unused equity in that asset. So what would you be better off, having 3 properties going up in value or 1 property going up in value? 3 properties going up in value. So what you would do is you tap into the equity of that one investment property, refinance that, take out, well, in this example of it, you could take out like $400,000 and then buy 2 more properties. Now I have 3 properties going up. Yes, my expenses are higher, but do I really need the cash flow? All I want to do is look at breaking even on the cash flow basis, or maybe losing a little bit of money per month. But will 1 property change my life? No. But could 3 properties change my life over 30 years? Yes. So the general consensus is one needs to move to multifamily to use cash flow. Let me read this before I start saying it out loud. Okay, no, this is a good question. So the general consensus is that one needs to move to multifamily to use cash flow to own under a corporation to qualify for mortgages. However, based on what you are saying, one can stay in single family investing in rentals, as everyone can get a mortgage as long as you're open to higher interest rates, etc. Looking at Alex's portfolio, majority is single family dwellings. Correct, yes. And I will say, majority of them are condos, not houses. Houses are a pain in the ass. Condos are easy, but that's again a whole nother conversation. Yeah, no, you can do that. I know, I'll just say, I know, for example, and I don't know what it is today, but I know National Bank allowed you to have 20. Last year, they're like, hey, you can have 20 properties. We'll give you mortgages for 20 properties, because they wanted to increase the amount of mortgage they had. So again, it just depends on what banks are going to give you mortgages for. Here's the great thing about
just a new pipe on that. They recently have allowed 40.
There we go. They're up to 40 now. So here's the thing about and again, I do like multifamily. Like I have an apartment building in Hamilton. I got a triplex around the corner from where I currently live. There are attractive aspects to multifamily. Problem with multifamily is that it's a little bit of liquid, and it's a lot more work, active investing. There's a lot more work that comes to owning a multifamily property. A condo is a concrete box in the sky. All I'm concerned about is what's inside the box. It's all I got to deal with. And people that have young families or busy professionals, all they care about is they want to own some real estate. They just want to deal with what's in the 4 walls. If that, they don't want to deal with anything else. But if I have that multifamily or even a house or a semi or anything like that, I'm dealing with what's inside the house, what's inside the walls. I'm dealing with the exterior of the property. Then I'm doing the land on the property. A lot more things can go wrong with it, and that's where the active management comes into play. But the great thing about having single family versus multifamily, the other thing where I said multifamily is a little bit of liquid, residential is not. So if I had, let's say for example, I had a $2 million multifamily property, or I had 4 or $500,000 condos. Well, if I wanted to sell the multifamily, I got nothing. But if I wanted to sell 1 condo, I still have 3 condos. So I can cash in for 500,000 and still have 3 condos. But if I wanted to get rid of the multifamily, once it's gone, it's gone. So and also when I'm selling a condo, I'm selling a condo generally to someone that is going to move in, and that's going to be the roof over their head. So they're evaluating that purchase price on their fundamental need to live somewhere. Their rationale usually generates a higher purchase price than a multifamily, because a multifamily is based purely on cash flow fundamentals and cap rates. So there's higher upside on the residential side. But here's the great thing: there are lots of ways to make money in real estate. I like just focus. Okay, I got multiple hands in different areas, but what I find is if you just focus in on one thing and do that really, really well, that's what you're going to make the most money on.
Well said.
What eligibility criteria to get commercial financing to buy commercial property in a situation where a borrower already has a mortgage on 5 residential properties? As long as the numbers on the commercial property are good, you're fine. That's easy.
Correct.
Yeah.
It goes back to that 80-20. With commercial, they generally don't care about the character, collateral, credit of the person. They're just looking at the actual property and its cash flow.
Yeah. If interim occupancy for a pre-construction condo is spring 2024, how early should we apply and get approved for a mortgage?
My answer is always immediately, because it goes back to that example. Someone goes on mat leave, their situation changes. It's better to have something locked in before, the rates rise potentially even further, and you hit something called an approval cliff where you're unable to get the approval. So there is no amount of time in advance that I think is negative. So my answer is sooner the better.
And also, if there's a problem, right? Let's say they come 2023. Hey, Emmett, I need a mortgage. And you're like, what's this? And they're like, oh, I didn't know about that. Like you have over a year to fix it.
You have time to fix it. I have seen people lose a mortgage over a $60 Rogers bill that went into arrears that they didn't know about. But you can fix that. So if you try and get your mortgage a month before, you ain't fixing it. You need 3 months to fix that problem. So yes, it's always good to do it in advance, because you don't know what's coming in the future.
On a 500,000 pre-construction condo, how much should I budget for closing costs? Depends. I need more information. I need development caps. I need to see the contract. Depends on what city it's in. If it's in Toronto, if it's outside of Toronto, if it's another province. I need more information on that. If I buy a condo in a master plan community, phase 1 pricing is, let's say, 500K. Phase 3 pricing is 650K for the same unit. At the time of closing, if I want to refinance, then what value will be appraised value? Does phase 3 builder seller price drive it? No. It's based on resale pricing. If I own an investment condo for more than 8 years and I would like to refinance and get the equity out as cash, however, due to COVID, I came unemployed, can I still get a refinancing mortgage? I'll leave that one to you.
It's circumstantial. There was a question I answered before we started all this, and if you're retired, there's different programs for certain people over 55. If you have net worth, you can get approved. If you are cash flow positive on some of those properties, you can get your mortgage done. There are some lenders that will lend up to 50% of the appraised value, no questions asked. So I think I need more information. I would say it is possible. It would be circumstantial.
Yeah, 100%. I like this question because this one here, people ask about it, and it doesn't exist here. If you own multiple properties and sell one, is there a strict timeline to reinvest within 6 months to be exempt from capital gains? No.
That's an American thing.
Yeah, wrong country. It's an American thing. So if you're buying into those real estate investing courses, and what's it called, the 10 something, it's 1033 or something like that. Yeah, that all American. There is you cannot reinvest your funds to avoid capital gains. Once you sell, you pay your capital gains tax. Good question though. This is going to lead.
Here's the kicker though, right?
Yes,
this is where you're going to jump
new.
in.
This is new. Yeah.
When you instead of selling, if you keep refinancing, all the money you pull out is tax-free. That's the kicker.
Yeah. Oh, and that's the beauty. That's why you never sell. You never sell, and you just refinance money out. But what I was going to say, though, that actually wasn't what I was going to say. I was going to get into new tax law. So starting in January 2023, the government is enforcing a 1-year time frame to own a property. Otherwise, you don't even get capital gain. Your full profit goes into income. This, like, for me, it makes no sense to sell an assignment, and now you can't even close on a property and then sell it in 6 months. You can. Sorry, I shouldn't say you can't. You can sell. You can. The government is just going to take a larger piece. They're going to, let's say you make $100,000 profit, they will take that whole $100,000 in income now. If you waited, instead of waiting 6 months and you waited a full year, then you would only have to take $50,000 of that into income versus the 100,000. So a lot of people,
and they've overwritten the primary residence. So if you buy a house, so
doesn't even matter.
Doesn't
matter with your primary residence.
Yeah, it doesn't matter. I had a client bought a house in January, realized they can't afford it, sold it, and moved back home. They're in trouble. They need to pay the tax on the whole amount.
Yeah.
So in Canada, you're not taxed on your primary home, but this new rule is an override for the first 12 months.
Now, does it stop you from selling? No, you can still sell your house. You will just pay more taxes.
It's got to pay Justin Trudeau his share.
Correct. Yes. So that was a great segue that question led to. What are your due diligence steps, concerns to screen a private lender, foreign lenders?
Private lenders, I think the question is asking, how do I make sure if a private lender is reputable and that they're good? That's where our due diligence as brokers comes in. There's 1,000 private lenders out there. I probably only deal with a dozen. I like them to have a good reputation so that they're not chasing like sharks after clients, because there are private lenders that if you default after an hour, they will come after you. Foreign lenders, I don't generally like to deal with foreign lenders because they have their own capital gains issues, and how do they get the money over here? There could be, anti-money laundering issues. So the answer is we generally will try and work with private lenders, and we keep that number to a minimum.
How often can you get appliances or closing costs rolled into the purchase price and mortgage? Never. Well, I'll back that up. Appliances, if the builder included the appliances, then yes. So if the builder included the private appliances in the deal, then yes. But other than that, no. Yeah. Can you refinance in the possible case of no present income? I think it goes back to your question.
We answered that.
Depends on the circumstance. If there's a significant amount of equity, there are some lenders that would just lend on a 50% loan to value. But
there's a whole segment of lending for people 55 and over where no income is required. Yeah. So it's circumstantial.
Well, everyone, you've given us over an hour of your time. Amit's given us over an hour of his time. We have recorded this, so everyone on here will get a copy of this recording so you can review it. And of course, you can reach out to us at any time with any questions you have. An email will go out with all of Amit's contact details, so you can ask any questions that you may have. But the mortgage relationship is the key to building the multi-million-dollar real estate portfolio, and working with someone that knows how to deal with investors is key. And Amit's experience over all these years and his background in accounting really shines through. So again, thank you everyone for coming in online. If you have any more questions, send us a message. If you were on here, you would have got my email, reply back, but also you'll get a recording. So thank you everyone. Thank you, Amit. Really appreciate it.
Alex, my pleasure. And thank you for everyone for tuning in.
Awesome. Thanks guys. Bye-bye.